Let's start with the data in the United States of America. Since you've been speaking this afternoon, we've got another read on core inflation, 1.9%, the least since October 2015. The break-evens are beginning just to dip quite aggressively, the expectations of inflation. We've written an article, is this the goodbye to inflation, or is that too harsh?
Well, I haven't had a chance to look at the most recent inflation data. I know that last month, both inflation indicators stepped down unexpectedly. My view has been I'm just going to sort of look through that until I get a better reading as to whether or not it's altered its trajectory, as you're suggesting, or if it's just sort of a little pause like that. So I think it's going to take a few months to sort of sort this through. I will say that I have been a bit cautious, nervous about inflation. I think it's extremely important that the Fed be able to get our inflation data up to our inflation objective of 2%. And I think that we have a symmetric inflation objective, so that we should be on either side of 2% most of the time, and we need to get it up.
The conversation that you've just had downstairs was, I thought, very relaxed, very convivial, and you said, look, I don't know whether we'll spend as much time above target as we did below target, but when I look at what the market is expecting, there's still this broad difference between what the Fed expects from rates in a couple of years' time and what the market expects. The last time Bloomberg caught up with you, you were 2 rate hikes for 2017. Do you still stand by that, given the temperance in the data?
Well, my outlook hasn't really changed that much. I think, if anything, maybe it's, well, except for the first quarter data was weaker than I would have hoped for, certainly. We're kind of looking for the second quarter to make up for that, so it averages back closer to my 2.25 rate increase. I am mindful of the fact that for many years we've started off thinking that growth would be stronger, and by the time we were finished, it was a little bit lower than that. So, but the unemployment rate's at 4.4%. We've had strong employment growth for quite some time. This ought to support getting inflation up to our 2% objective, but I do think that we need to get it to 2%.
And you were very clear about that is our mandate, along with full employment. But the debate around wages, and you mooted the discussion around slack when we were down there. But if I look at the wages data, and again, this comes back to, it's a little bit like the CPI data, a little bit of a question mark the market will put beside it. The wages data, 2.5%, does that muddy the path to the higher land of rates for the Fed?
Well, I think that, yeah, right. So I think, normally you would, sort of hope that wages would be growing in the 3 to 4% range. Inflation target of 2 plus productivity growth, you get sort of 3 to 4%. Not quite sure which one, dominates that. We're at 2.5, 2.75, depending on the measure. They say that it's difficult to find workers with the appropriate skills. You would think that that would lead to skills being bid up even more than that, and yet it's been
it just
somewhat
hasn't happened
reduced.
That way.
So I'm hopeful that it's going to move up. I think that resource slack has certainly been eroded quite a lot. We're probably at 4.4%. Arguably, we're at full employment.
Let's talk about that full employment. We probably don't have enough time in this entire interview to get into the nuances of what full employment is. But one thing that struck me was a 10-year low for unemployment rate. Is the natural rate of unemployment fit for purpose? And does that have implications for the Fed?
The median Fed participant has 4.75 is their estimate of sustainable unemployment. I'm actually on the lower end of that. My staff has looked at demographics, and possibly 4.5% could be full employment. There's sort of a concern maybe that inflation pressures are nonlinear as you go below the natural rate of unemployment. So maybe we'll all of a sudden see Phillips curve inflation contributions pick up a little bit more if we keep moving down. I don't know, but we'll be mindful of all of this. I would say that getting more people into the workforce, employed with time on the job, building skills, ultimately has a longer-term productive effect. There have been people, out of work for quite some time, and they would benefit from this. And so I think it supports stronger growth in the future as well. But we do have to be mindful that undershooting too much can come with additional costs.
Those additional costs could cause some concern. Governor Kuroda over at the Bank of Japan, he used a phrase this week. He talked about animal spirits and escape velocity. When I look at the certain data points that we've discussed so far, give me your phraseology for U.S. recovery so far, because there's a flashing light over that backward-looking GDP in first quarter. Escape velocity, is it there? Is it on the table? Is that what you sense in the U.S. recovery?
Yeah, so if you go back to 2011, 2012, 2013, I just kept saying we need to achieve escape velocity. We need to get growth up. Unemployment, at one point, we're facing 9%, 8%, 7%. But now we're down at 4.4%. We blew through that escape velocity, and we just sort of had, steady, lower than what we would have hoped for growth. But it kind of worked out. As it turns out, it took longer. Would have been better if we'd gotten there sooner, but monetary policy could only do so much, and we would have benefited from additional other policies that help stimulate that. Here's where we are. I think we're very close to full employment, if not at full employment, and so escape velocity beyond this is just very difficult to achieve stronger growth. First quarter was weak. Second quarter might make up for that. I think that over the second half, we're going to, see those 2.25 growth dynamics reemerge. That's my expectation.
Let's see what comes through, I suppose, from the fiscal side from Congress.
There's that too. Yes, that's right. So it's difficult to have a strong assumption about fiscal policy. It could be extremely strong if the tax cuts, as the Trump administration have proposed in the one-pager, or if it doesn't really take place, or if something much more muted and it takes longer to implement. So there's an awful lot of uncertainty. It's very difficult to put that into any forecast.